Welcome to the SOT System channel. One day after the Federal Reserve cut rates by a quarter point, markets were steadied to modestly higher, an encouraging sign that policy is easing without unsettling investors. Because a 0.5% move was widely expected and largely priced in, the calm reaction reflects confidence that easier financial conditions are arriving as planned. The Federal Reserve, the U.S. central bank, guides interest rates and the money supply with a dual mandate: maximum employment and stable prices. This cut is a proactive step to support growth amid softer job data, fading tariff uncertainty, and resilient consumer spending. The federal government, the economy's largest borrower and spender, carries about $37 trillion in debt with roughly $2 trillion of expected borrowing in 2025. Lower rates gradually reduce Treasury interest costs as debt rolls over, freeing fiscal space and lowering financing headwinds, both constructive for economic momentum. While the Fed doesn't set mortgage or credit card rates directly, its policy moves lower banks' funding costs. That typically opens the door to cheaper loans and refinancing, putting more cash in consumers' and businesses' pockets and reinforcing a positive growth cycle. Asset implications: real estate. Lower yields can translate into more affordable mortgages, refinancing waves, and renewed buyer activity. For income property and rights, cheaper financing and cap rate compression can lift valuations and support dividends. Stocks: a lower discount rate boosts present values and reduces borrowing costs, a tailwind for growth names, small caps, and capital-intensive sectors. Improved credit conditions can also support earnings durability and risk appetite. Gold: if cuts push down real inflation-adjusted yields or ease the dollar, gold often firms as a portfolio diversifier and store of value, helpful ballast alongside risk assets. Bitcoin: easier policy and rising liquidity tend to support risk-on sentiment. Falling real yields and friendlier financial conditions can boost the digital gold narrative and investor flows, while crypto-specific catalysts can add upside volatility. Bottom line, the rate cut lowers the cost of capital, encourages refinancing and investment, and broadly supports asset prices. It's a constructive backdrop for homeowners, entrepreneurs, and investors, especially if inflation keeps trending down and real yields ease.